All right, welcome everyone. This is Bob Maurer. It is Friday, the 20th of September, around about 1:30 my time. I want to do a deeper dive into a couple strategies that I introduced recently. Strategies number 320, in corn. 320 is the corn bull spread, and the next one is 321. It is the bear spread in rough rice. So let's hop into those. I want to give you the backstory on those. So we'll all be on the same page. Dialing into the portal, you'll see on the sheet the two strategies I'm talking about here. Number 320, bull spread corn, bear spread rough rice, number 321. And let's hop over to the charts. First, we'll do corn. I've been in this one for a bit, so you're probably familiar with it in terms of just how it's been trading. But I wanted to go into the depths of why I published it. All right, so strategy number 320, first of all, in yellow here on the left. Long D, short March. Margin requirement, I think, is around 330 ish. Risk reward, regular entry, more conservative entry, risking $100 per spread to either make 175 or 237. More aggressive average in traders, risking 275 per two lots, either make 275 or 400. If all you do is get in at level 1 and then it breaks down to our targets, or rallies to our targets, then the game would be 100 at the lowest target. All right. We are looking to get long. This has been a profitable strategy 14 out of the last 15 years. The one losing year was 2017. And in terms of sizing of 2017 relative to the chart you're looking at right in front of you there, I don't see much correlation in terms of the entry price going into the seasonal, but I do see correlation in terms of the structure of the chart. Okay. So I don't think that's immaterial, but nonetheless, I think what's more notable is the fact that we're sitting at a historically wide spread, right? So this thing a few weeks ago got down to a low of negative 19.75. Okay, that's this low right here. This little pop to the downside. And in 2008, it was also another fairly wide spread to the tune of about negative 20. Okay, so about a penny lower than we got to, or not even a penny, just a tick or two lower than we got, or these months that you're looking at here in this chart got. And after in 2008 it got down to negative 20 or so, it ended up pushing up higher over time. So basically 2008 might be more of a correlation than 2017. So 2017, like I said, structure was such that it was similar to this, okay, but not as wide of a differential in price. So I would say that the 2008 correlation is probably stronger than 2017, even though 2017 was a bit of a loser, not a big deal. Anyway, net, I think that this would be a good place to pick up this particular spread, being that the spread is fairly wide, and we're looking for it to narrow because we're going on the bull side. It's not like we're looking for it to break even further. That wouldn't make sense. Okay, so that's where we're at with this one. That's the backstory. The benchmark to stop range. So benchmarked at negative 18.5. Our stop is negative 23. That is 4.5 cents. That's $225. That would have been enough room. 15 out of the last 15 years to stay on board with this. Okay, so that all sounds good. All that analysis lines up nicely for me, and that's why I published it. And where are we trying to get in? Well, negative 19.5 would be level 1. Negative 21 is level 2. Stop is negative 23. And then our target's up here, negative 17.5, 16.25, negative 14.75. So we need this thing to dip down and then rally up. And then we'll be in good shape. All right, so that is strategy number 320, the bull spread in corn. Next one is a bear spread in rice. So this is strategy number 321. rough rice bear spread, long January, short Nove, margin requirement just shy of $1,400. That's much higher than average for us. Usually we're in the, say, $500 to $800 range for spreads, if not even lower. So that's an indication to you that the clearinghouse believes that this could be a rather volatile spread. All right. So keep that in mind. If that spooks you, just don't do it. No big deal. Regular entry level 2 traders, risk reward, risking 100 to make either 200 or 260. More aggressive average in traders, risking 250 to either make 340 or 460. All you do is get in at level 1, and then the market breaks down to the first target. The game would be about 170. And the backstory on this one is it's been a profitable strategy 14 out of the last 15 years. The losing year was 2013. In 2013, I do see correlation in terms of both price and structure of the chart, but I'm not overly concerned because in that year 2013 the market bounced, so it moved higher like it's doing right now. Then it broke to an extent that would get really close to our negative 22 here. Okay, so it went up and it went down and went down over time, and then in the very tail end in 2013 it spiked higher. And as you notice, October 22 is getting close to first notice day. I don't think we're going to be in this very long or that long. We'll see how it plays out, but I'll keep that in mind, right? So we want this thing to do what it did in 2013, actually, even though that was a losing year, okay? There was an opportunity during the window, the seasonal window, to make money to the tune of what we're trying to do. So it rallied, then it broke, then at the tail end it rallied again. All right, so we're okay. I don't mind that. Sometimes, even though there's been a losing year in the past, as long as at some point during that losing year or losing years, the market ended up with some kind of unrealized gain, all right, and we can adjust our targets for that, then we're good. Okay, so the benchmark to stop range, our benchmark negative 15, that's where it settled on 16th of September, and our stop is negative 7, so that's an 8-cent range. Each penny in rough rice is $20, so that's a $160 range, and that would have been enough to be on board, stay on board 14 out of the last 15 years. The one exception is the 1 year that I just dove into, which was the losing year in 2013, which is where it became a loser right in the tail end of the trade, or the tail end of the window. All right, so I think we're in good shape in terms of giving it a good amount of room statistically. And what are we looking to do? We're looking to get short. Levels are negative 15, so entry level 1 right at the benchmark is negative 15. So negative 15 or better is where you want to get on the first half of your allocation if you're a more aggressive average in type trader. Second level will be negative 12, okay, and then our stop is negative 7. Targets are negative 22 and negative 25. So we want this thing to rally and then break and then fill us, and then who cares what happens after that. But we'll keep an eye on it if we're still in this into the last 25% of this window. All right, so that is bear spread in rough rice, strategy number 321. We got the entry and exit levels, we got the risk reward, and we have got the backstory. So everybody should be on the same page. All right, so I'm going to leave it there. Hope you guys have a great weekend planned for yourselves, and thanks so much for watching.